Disclaimer.
December 26, 2025. While Americans' unwrapped presents and British traders nursed their Boxing Day hangovers, something extraordinary happened in our financial markets. Silver exploded to $77.44 per ounce, an all-time high that shattered records dating back to the Hunt brothers' legendary squeeze in 1980. But here's what should grab our attention. London markets were completely shut for the holiday. The largest physical silver trading hub on planet Earth went dark at the exact moment when price discovery mattered most. Think about that scenario for a moment. You're JPMorgan, and according to reports from multiple commodity analysts, you just flipped from holding the world's largest short position, roughly 200 million ounces that you have been accused of manipulating for over a decade, to accumulating what is being called the largest physical silver stockpile in private hands. We're talking about 750 million ounces of actual metal, not paper contracts. That's more silver than many countries hold in their strategic reserves. And now you're facing your first major test without London's liquidity to help cushion the blow. Here's where it gets interesting. JPMorgan didn't just wake up one morning and decide to become silver bulls. Between June and October of this year, something fundamental shifted in their strategy. While our mainstream financial media was obsessing over tech stocks and Bitcoin ETFs, one of Wall Street's most powerful banks was quietly executing what might be the largest commodity position flip in modern history. According to data compiled from COMEX filings and analyzed by metals research firms, they went from being the entity that regulators accused of suppressing silver prices to potentially becoming the single largest beneficiary if those prices explode. Pop quiz. What happens when the world's most sophisticated trading desk, which paid $920 million to settle manipulation charges just 5 years ago, suddenly switches sides in a market they allegedly controlled? We're about to find out. The timing of this Boxing Day surge wasn't random. 2 weeks earlier, on December 10th, U.S. authorities seized a Venezuelan oil tanker. Then another one on December 20th. President Trump's renewed Venezuela blockade deployed 15,000 troops and effectively choked off one of the last major oil arteries feeding global markets outside of our direct control. When you cut oil supply in today's fragile energy landscape, traders don't just buy oil futures, they panic buy hard assets across the board. Gold, silver, copper, anything that's real and can't be printed by a central bank. But Venezuela is just the match that lit the fuse. The explosive material was already packed and ready. According to a December 2nd COMEX report that barely made headlines in our financial press, U.S. banks turned net long in silver for the first time in recorded COMEX history. Read that again. For the first time ever, our major banks collectively decided they wanted to own more silver than they wanted to bet against it. This isn't a minor position adjustment. This represents a complete philosophical reversal in how Wall Street views this metal. Now layer in the holiday timing. Trading volume on December 26th was running at roughly 30% of normal levels. Most institutional desks in New York were operating with skeleton crews. Serious players were either out of the office or managing positions with one eye on their families and another on their screens. In normal markets, this thin liquidity might cause a few dollars of volatility. But when you've got a potential short squeeze brewing, when physical buyers in Asia are desperate for metal, and when London, which typically trades over 200 million ounces per day, is completely offline, thin liquidity becomes a weapon. Here's what you need to understand about our silver market structure. There are two prices that matter: the paper price on COMEX in New York and the physical price where real metal actually changes hands. On December 26th, Shanghai traders were paying $7 to $8 premiums over the COMEX price for physical silver. That's not normal. That's not even close to normal. According to traders who spoke to metals publications, that premium represents a market screaming that paper contracts and physical reality have completely divorced from each other. Think about this from an industrial user's perspective. You're a solar panel manufacturer in the United States, and you need silver to coat your photovoltaic cells. You can't use a COMEX futures contract to build your product. You need actual metal delivered to your factory. But when you call your supplier, they're telling you that the price on the screen isn't the price they can deliver metal at. They need 7 or 8 more per ounce just to source physical product from refiners who are running at absolute maximum capacity. Meanwhile, electric vehicle makers are competing with you for the same tight supply. Consumer electronics companies need silver for their circuit boards and connections. And now on top of all that industrial demand, you've got investors who looked at their portfolios over Christmas and decided that with oil blockades, bank failures, and geopolitical chaos, maybe owning some physical silver isn't such a crazy idea after all. The math gets uncomfortable fast. Global silver mine production in 2025 is running at approximately 880 million ounces, according to the Silver Institute. Industrial demand alone is consuming roughly 1.2 billion ounces this year between solar, EVs, 5G infrastructure, and traditional electronics. We're not talking about a small gap that can be filled by recycling and above-ground stocks. We're talking about a structural deficit where the world is consuming 300 million more ounces than we're pulling out of the ground annually. And here's the kicker that keeps our industrial planners up at night. You can't just flip a switch and produce more silver. Mining projects take 7 to 15 years from discovery to production, according to industry analysis from major mining consultancies. Environmental permits, capital raising, infrastructure development, engineering studies, all of that has to happen before a single ounce of new primary production comes online. What we're mining today was decided when Obama was still in his first term. So picture the scene on December 26th from JPMorgan's trading floor. London is closed, eliminating hundreds of millions of ounces of daily liquidity. Shanghai is paying massive premiums, signaling that physical buyers will take every ounce available at any reasonable price. Venezuela tensions have global markets on edge. Your bank reportedly holds 750 million ounces of physical metal. That's roughly 85% of annual global mine production sitting in your vaults. And the paper market, where you control 40% of COMEX futures, is starting to crack under the weight of reality. The question isn't whether something breaks. The question is when and how violently. Because unlike stocks where you can always issue more shares, or bonds where central banks can print more currency, or even gold where central banks hold massive reserves they can lease into the market, silver has a unique vulnerability. It's being consumed industrially at a rate that exceeds new production, while simultaneously being hoarded as a monetary hedge by a growing number of sophisticated investors who've studied exactly what happened to our dollar's purchasing power over the last few decades. What happened on Boxing Day wasn't just a price spike driven by thin holiday trading. It was a warning shot that the paper price discovery mechanism we have relied on for decades might be approaching its mathematical limits. And if JPMorgan really did flip from short to long with that massive 750 million ounce position, then the single entity with the most knowledge of how this market operates, the same entity that paid nearly $1 billion for allegedly manipulating it, has apparently decided that betting against silver's rise is no longer the winning trade. That's not bearish. That's not even neutral. That's the kind of positioning that suggests someone knows something big is coming, and they've made absolutely certain they're on the right side when it arrives. The only question left for the rest of us is whether we've been paying attention. Let's talk about what JPMorgan actually did and why the evidence suggests this is not just another Wall Street trade. It's potentially the setup for one of the greatest wealth transfers in commodity market history. In September 2020, our Department of Justice announced that JPMorgan would pay $920 million to settle charges of spoofing and manipulation in precious metals markets. According to the settlement documents, their traders systematically placed fake orders to move prices from 2008 through 2016, profiting from a scheme that prosecutors called brazen and systematic. Here's what should make you pause. That $920 million fine was for manipulating markets while they were short. They made money by suppressing prices, shaking out long positions, and accumulating metal at artificially depressed levels. The settlement covered 8 years of trading activity, involved multiple traders, including their global precious metals desk head, and represented one of the largest commodity manipulation cases in U.S. history. These weren't rogue employees. According to the Justice Department, this was institutional strategy. Now fast forward to 2025. Multiple commodity analysts tracking COMEX warehouse stocks, ETF holdings, and London vault movements estimate that JPMorgan has accumulated somewhere between 650 and 750 million ounces of physical silver. Let me put that number in perspective for you. At current prices around $77 per ounce, we're talking about $58 billion worth of metal. That's more than the entire market capitalization of Ford Motor Company sitting in vaults in the form of silver bars. But the real comparison that should interest you is this. The Hunt brothers, who famously tried to corner the silver market in 1980, controlled roughly 200 million ounces at their peak. Their position was so large that it triggered emergency rule changes from regulators, congressional hearings, and ultimately a spectacular collapse that changed commodity trading regulations for decades. JPMorgan's reported position is 3.75 times larger than what the Hunts controlled. And unlike the Hunts, who were outside players fighting the establishment, JPMorgan is the establishment. Think about the strategic implications here. You spend 8 years manipulating silver prices downward, pay $1 billion fine when you get caught, then spend the next 5 years accumulating a position that dwarfs the most famous silver squeeze in history. According to COMEX data analyzed by metals research firms, JPMorgan now controls approximately 40% of COMEX silver futures and options. That's more concentrated than what the Hunts held when regulators panicked and changed the rules to stop them. The difference is intent and timing. The Hunts wanted to profit from a squeeze. If the reports about JPMorgan's accumulation are accurate, they're not trying to squeeze the market. They're positioning for what happens when the market squeezes itself. Because unlike 1980, when silver was primarily a monetary metal competing with gold, Today's silver has become absolutely critical to our industrial infrastructure. Have you noticed how many solar panels have gone up in your neighborhood over the past few years? Each residential solar installation uses roughly 20 grams of silver per panel, and a typical home system needs 20 to 30 panels. According to the Silver Institute's latest World Silver Survey, solar photovoltaic installations consumed approximately 165 million ounces of silver in 2025. That's up from just 50 million ounces in 2015. We're not talking about gradual growth. This is exponential demand driven by our clean energy transition, and it's not slowing down. U.S. government mandates require massive solar capacity additions through 2030. Europe's Green Deal demands similar expansion. China is installing solar at a rate that exceeds the rest of the world combined. Every single one of those panels needs silver because it's the most conductive, most reflective, most reliable material we have for converting sunlight into electricity. You can't substitute aluminum or copper and get the same efficiency. We've tried. Electric vehicles tell the same story. A conventional car uses about 15 to 20 grams of silver in its electrical system. An electric vehicle uses 25 to 50 grams. And that number increases for every additional sensor, every autonomous driving feature, every piece of advanced electronics we add. According to automotive industry analysis, global EV production in 2025 hit roughly 14 million units. That's consuming approximately 50 million ounces of silver annually just for the vehicles themselves before you count the charging infrastructure. Then add 5G networks, which require silver in every antenna, every connection point, every signal routing system. Our military systems, which use silver in radar, missile guidance, and communication networks. Medical devices that rely on silver's antimicrobial properties. The list goes on, and every category is growing, not shrinking. When the U.S. Geological Survey added silver to our critical minerals list in 2022, it wasn't because they were worried about running out next year. It was because they could see the structural deficit approaching and realized our industrial base was becoming dangerously dependent on imports. Let me show you the math that keeps supply chain managers awake at night. Global mine production of silver is approximately 880 million ounces per year, according to the Silver Institute. Industrial demand alone consumed roughly 1.2 billion ounces in 2025. That's a 320 million ounce deficit that has to be filled from somewhere. Where does it come from? Recycling provides about 180 million ounces annually. Government sales and de-hedging might add another 50 million ounces in a good year. Investment selling can fill the gap temporarily, but what happens when investors stop selling and start buying? That's exactly what's happening now. According to ETF flow data compiled by Bloomberg, silver ETFs saw inflows for 4 consecutive weeks heading into Christmas. Year-to-date inflows are up between 130% and 158%, depending on which funds you're tracking. These aren't retail investors panic buying coins at their local dealer. These are institutional allocations, pension funds, sovereign wealth funds, deciding that silver deserves a place in diversified portfolios. And here's where Venezuela enters the picture in a way that connects all these threads together. When President Trump seized those Venezuelan oil tankers in December, he wasn't just enforcing sanctions, he was sending a message to every country that relies on oil from nations outside our sphere of influence. China imports roughly 25% of its crude oil from countries we've sanctioned: Venezuela, Russia, Iran. That's not a minor supply chain diversification. That's strategic dependence on sources that our government can disrupt with the stroke of a pen. What do you do if you're China or Saudi Arabia or any major economy watching us weaponize the dollar and commodity supply chains? You accelerate your shift into hard assets that can't be sanctioned, frozen, or controlled by Western financial systems. According to the World Gold Council, central bank gold buying hit record levels in 2023 and remained elevated through 2025. But silver offers something gold doesn't: the dual benefit of being both a monetary hedge and an industrial necessity. The BRICS nations, Brazil, Russia, India, China, South Africa, plus the new members added in 2024, represent over 45% of global population and a growing share of GDP. When these countries discuss creating alternative reserve currencies, reducing dollar dependence, and building parallel financial infrastructure, they're not having theoretical debates. They're moving assets. According to customs data from multiple countries, silver imports by BRICS nations increased substantially in 2024 and 2025, though exact figures are difficult to verify due to strategic ambiguity in some reporting. Let me connect one more piece of this puzzle that demonstrates how tight physical silver markets have become. Refiners globally operate at near 100% capacity according to industry sources. When you call a major refinery and ask them to produce more silver bars, they don't tell you the price. They tell you to get in line. Lead times for converting silver doré from mines into investment-grade bars have extended from the traditional 2 to 4 weeks to 8 to 12 weeks or longer for large orders. Think about what that means in practical terms. You're a hedge fund manager. You decide silver looks attractive. You call your broker to buy 10 million ounces of physical metal. Your broker calls refineries and finds out that even if you're willing to pay a premium, you're waiting 3 months for delivery. Meanwhile, the paper price on COMEX says silver is instantly available at $77 per ounce. Does that make sense to you? It's like trying to buy a house where Zillow says it's worth $500,000, but every seller you call wants $550,000 and there's a 6-month waiting list. That's the arbitrage bomb I mentioned earlier. Shanghai traders paying 7 turned into 8 premiums over COMEX aren't being irrational. They're telling you what physical silver actually costs when you need it delivered to your location in usable form. According to traders operating in Asian markets, those premiums would be even higher if there were enough metal available to satisfy demand. The premium isn't high because buyers are desperate. The premium is constrained because there simply is not enough physical silver changing hands to establish true price discovery. Here's the most important thing to understand about all this evidence. JPMorgan didn't accumulate 750 million ounces because they thought silver might go up 10% or 20%. Position of that size in a market this tight, with industrial demand this strong, only makes sense if they're positioning for a fundamental repricing of silver's value relative to everything else. They spent years studying this market, manipulating this market, understanding exactly how it works and where the vulnerabilities are, and then they switched sides. That's not speculation. That's pattern recognition based on documented behavior and reported positions. The same bank that paid $920 million for suppressing silver prices apparently decided the winning trade is not shorting silver anymore. It's owning more silver than any private entity in modern history. When the people who wrote the playbook suddenly change teams, you should probably pay attention to what game they're preparing for next. Because if they're right, the $77 price we saw on Boxing Day might look quaint in hindsight. And every industrial user, every investor, every nation trying to secure supply is about to learn a very expensive lesson about the difference between paper claims and physical reality. Now, let's run the numbers that Wall Street doesn't want you thinking about too carefully. If JPMorgan really holds 750 million ounces of physical silver and controls roughly 40% of COMEX futures contracts, while the broader market is just beginning to realize that paper prices can't actually deliver physical metal at these levels, what's the mathematical endpoint? To answer that, we need to look at the only comparable situation in modern history, the Hunt brothers squeeze of 1980. In January 1980, silver briefly touched $49,000, $45 per ounce, before regulators changed the rules and crashed the market. That price, adjusted for official inflation using the CPI calculator from the Bureau of Labor Statistics, equals roughly $185 per ounce in today's dollars. But here's what makes our current situation potentially more explosive. The Hunts were trying to create an artificial squeeze in a market that didn't have structural supply deficits. They were fighting against natural market forces and the full weight of regulatory opposition. Today's silver market does not need anyone to create a squeeze. The industrial consumption deficit is doing that automatically. Let me walk you through 3 scenarios for what could unfold in the next 72 hours and beyond, based on technical analysis and historical precedent. Scenario 1, the failed smash. This is where large, short players, possibly banks that didn't flip with JPMorgan, attempt to crush silver's price when markets open fully staffed after the holidays. They dump paper contracts, trigger stop losses, try to create panic selling. If that fails, if silver buyers absorb the selling and the price quickly recovers above $77, that signals desperation. It tells you the shorts have lost control and they know it. Think about what happened with GameStop in January 2021. Except this time, the squeeze isn't driven by Reddit traders. It's driven by physical industrial demand and sovereign buyers with unlimited capital. When you short a stock, the worst that can happen is it goes to infinity theoretically. When you short a physical commodity that can't be delivered, you face the much more immediate problem of contract default or forced cash settlement at whatever price clears the market. That's not a theoretical risk. That's a your career ends and your firm takes massive losses risk. Scenario 2, the breakout cascade. Silver closes any day before December 31st, above $80 per ounce. This isn't just a psychological level, though psychology matters. According to analysis from commodity trading advisors, an $80 close triggers algorithmic delta hedging from options dealers who've sold calls at $85, $90, and $100 strikes. They have to buy futures to hedge their exposure, which pushes prices higher, which triggers more hedging, which creates a feedback loop. Technical traders call this a gamma squeeze. And in thin markets with limited physical supply, it can move prices 10 to 15% in a single session. From $80, the next resistance zone sits at $85 to $90 according to chart analysis from major brokerage technical research. Break through that, And you're in no man's land with nothing but air and the 1980 high standing between current prices and triple digits. Every dollar silver rises from here increases JPMorgan's paper profit on their reported 750 million ounce position by 750 million. At $100 per ounce, they're sitting on a $17 billion unrealized gain from their accumulation range. At 150, that's $55 billion. At 185, the inflation-adjusted 1980 high, they're looking at an $81 billion profit on metal they reportedly acquired mostly below 25 per ounce. But let's be conservative and focus on what happens if silver just consolidates between 74 and 78 through year-end. That's scenario 3, the pressure cooker. Every day that silver holds these levels, more industrial users panic about securing 2026 supply. More refiners get calls from desperate buyers willing to pay premiums. More investors realize that the paper price discovery mechanism might be breaking. And all of this tension builds toward January 28-29 when the Federal Reserve holds its first FOMC meeting of the year. Here's why that meeting matters. Markets are currently pricing in possible rate cuts for 2025, according to Federal Reserve futures data. Whether those cuts materialize depends heavily on inflation data and economic conditions. But here's the catch. If silver and other commodities are rising because of supply shortages rather than monetary inflation, the Fed faces an impossible choice. Do they raise rates to fight commodity price increases, potentially crashing an already fragile economy? Or do they cut rates to support growth, potentially pouring gasoline on commodity inflation? Either way, hard assets win that scenario. If rates go down, the dollar weakens and commodities rally. If rates stay elevated but the economy weakens, industrial users still need silver for solar panels and EVs regardless of economic growth, so supply shortages intensify. The only scenario where silver retreats significantly is if industrial demand collapses, and with our government pushing infrastructure bills, green energy mandates, and reshoring of critical manufacturing, that seems unlikely. Let me give you the specific technical levels that matter right now. $80 per ounce is the psychological barrier that hasn't been touched since the brief 2011 spike. Break above $80 with conviction, and algorithmic systems start treating silver like it's entering a new regime. The $85 to $90 zone represents the next consolidation range where profit-taking would be expected, but also where industrial panic buying could overwhelm sellers if companies realize they can't secure physical supply at lower prices. At $100 per ounce, you trigger mainstream media coverage. CNBC runs special segments. Bloomberg features silver in headlines. Retail investors who haven't thought about silver since their grandfather's coin collection suddenly want exposure. That media attention brings new money, which pushes prices higher, which creates more coverage, another feedback loop. According to Google Trends data, searches for how to buy silver spike dramatically whenever prices make new multi-year highs. Beyond $100, you enter territory where comparisons to the Hunt brothers become unavoidable. Financial regulators start paying attention. Congressional staffers begin asking questions. The CFTC, which oversees commodity futures markets, faces pressure to explain how one entity could accumulate such a massive position. But here's the crucial difference from 1980. If JPMorgan's position is primarily physical metal held in vaults rather than leveraged futures contracts, regulators have far less ability to intervene. They can change margin requirements on paper contracts. They can impose position limits on futures. But they can't force someone to sell physical metal they legally own. That creates a scenario where the upside might be limited more by industrial reality than regulatory intervention. At some price point, maybe $150, maybe $200, maybe higher, industrial users simply can't afford to manufacture their products. Solar panel makers shut down production lines. EV manufacturers delay model launches. That demand destruction eventually caps prices, but where that cap sits depends entirely on how critical those industries are to our economic and political priorities. Think about this calculation from our government's perspective. We've committed to massive solar capacity additions to meet climate goals. We've subsidized EV production with billions in tax credits and infrastructure spending. We've declared silver a critical mineral essential for national security. When silver prices spike, do you think our government tells those industries, sorry, silver's too expensive, cancel your projects? Or do they find ways to subsidize costs, provide emergency supply, or pressure other countries to increase exports? My bet, based on how our government has handled every other critical supply shortage, is that they'll do whatever it takes to keep strategic industries running, which means the price cap on silver might be much higher than simple manufacturing economics would suggest. Because if the alternative is admitting our green energy transition failed due to commodity shortages, that's politically unacceptable to both parties who've invested their credibility in those policies. Here's your timeline for maximum volatility. December 27th through December 31st represents the window where institutional desks are understaffed, London returns, but is still operating with holiday mindset, and the Venezuela situation remains unresolved. According to commodity market analysis, more major price moves happen in the week between Christmas and New Year's than most people realize, precisely because thin liquidity amplifies every trade. If you're going to force a short squeeze, this is exactly when you do it. January the 2nd brings full institutional staffing back online. Desks that were running with skeleton crews suddenly have their full teams analyzing positions, managing risk, making strategic decisions. That could bring massive new buying if firms decide silver's breakout is real, or it could bring selling if risk managers decide positions got too extended during the holidays. Based on current momentum and the structural supply situation, the odds favor more buying than selling once professionals fully engage. Then January 28th, 29 gives us the Fed meeting, which could catalyze the next leg higher regardless of what rates do. And all of this happens while our Venezuela blockade continues to send geopolitical risk signals through every commodity market, while China and BRICS nations accelerate their shift away from dollar dependence, while industrial silver demand continues consuming more metal than miners can produce. You want a specific target? If the current momentum continues and we break cleanly above $80, the next consolidation zone sits at $85 to $90. From there, a move to $100 becomes not just possible, but likely given the feedback loops I've described. Beyond $100, you're in territory where technical analysis becomes less useful than understanding political and industrial priorities. Could we see $150? Absolutely, if the supply squeeze intensifies and industrial users panic. Could we see $185, matching the inflation-adjusted 1980 high? It's mathematically possible, though it would require a level of mania that we haven't seen yet. But here's what you need to understand. JPMorgan didn't accumulate 750 million ounces to make 20% or 30%. Positions that large, built over years, only make sense if they're positioning for a fundamental repricing. They're not trading, they're waiting. And what they're waiting for is the moment when the rest of the market realizes what they already know. The paper price discovery mechanism that has governed silver for decades is breaking under the weight of physical reality. This isn't about predicting the exact top or timing every trade perfectly. This is about recognizing that we're watching a slow-motion collision between infinite paper contracts and finite physical supply, between industrial needs that can't be delayed and mining production that can't be accelerated, between a monetary system built on faith and a commodity required for our technological future. The Boxing Day ambush wasn't the climax, it was the opening shot. London was closed. JPMorgan was cornered into their first major test. Silver broke into price territory we haven't seen in modern markets. And now the question isn't whether something happens next, it's whether you've positioned yourself to benefit when it does. Because if history and mathematics have taught us anything, it is that when Wall Street's most sophisticated players flip from short to long in a market this tight, they're usually not early. They're just early enough.